good.
Did you share it to Hagerstown?
We're live now. Video's live.
Oh, is it?
Yeah.
What's going on, guys? It's Chris. We're here with Charles and our guest here, Jeremy, and we welcome you to our new episode. We're going to be talking about financing. Charles, you want to talk a little bit about what is going on today's show?
Yeah, basically, Jeremy here is going to be able to share.
I'm excited to be here, by the way.
And
First time in a new office.
Yes.
Video production studio is very clean.
Yes,
happy to
Thanks
be
for
part
coming,
of this with you guys. Been following you now since Fusion's been up online a couple weeks now, and I'm very, very, very interested in learning a little bit more about the videos that you guys are doing and putting together.
Perfect. And I'll be able to do that.
Yeah.
That is perfect. Basically, tonight Jeremy's going to go over all the do's and don'ts of mortgages, how to get a mortgage on your investment property, what type of paperwork you're going to need to know, and definitely if you're out there, you're investing in rental properties or anything that you're doing in the real estate arena, you're going to have to know what to do and what the banks are looking for, and that's what Jeremy's here tonight to go over.
Good cop, bad cop, right? Because everyone thinks that the underwriters and the mortgage lenders out there, sometimes are a very tricky hurdle to cross. Fact of the matter is, there are great programs that are out there to help men and women that are not only getting into homes for their families to be their primary residence, but there are also great programs for individuals that are looking to supplement their income.
That's true.
Through
And what we
income.
want to focus on, Jeremy's going to hit on a couple things like house hacking. If right now, let's say you are working from 9 to 5 or thinking about getting out, what's the best way for you to start your real estate investing journey? Could be maybe getting an owner occupant and get a 2-unit or a 4-unit. So we're going to learn a little bit of the financing side of things, and I hope you kind of shine light on a lot of people that are basically looking to do that in the next 6 months. Other than that, we definitely want to find out a little bit about your story. So how did you get started doing this?
Very, very good question. So how I got started, 1999, just out of school, working for PNC Bank, believe it or not, in Pittsburgh, Pennsylvania. I started in the U.S. Steel building. Got picked up through, I believe it was a recruiter at that point. Did not know where I wanted to be. I felt like I was going to be Mr. Wall Street. Showed up every day with my briefcase. Took public transportation.
You still do that now?
I do take a briefcase.
Still do
I
that?
literally would take public transportation. My shift was 1 p.m. to 9 p.m.
Oh, wow.
Headset on, dialer calls for PNC depository accounts, selling them home equity loans.
Oh, really?
Believe it or not.
I didn't know they do that. They cold call and they did
this was a pretty interesting time. So in 1999, early 2000, interest rates, prime rate at that point was north of somewhere around 6.5%, 7%. So rates weren't all that desirable at that point. By the grace of God, I met a young man who I'll always be grateful for. His name was Joseph Maggio, who was the owner of NSF Corporation in Pittsburgh, Pennsylvania. He was one of the pioneers in mortgage brokering. Had an opportunity to run into him, oddly enough, at a PNC ATM machine. I wasn't able to actually get enough money out to take public transportation that night to go home. Hate to admit that, but shamelessly, I was just out of school. I had the opportunity to sit and talk with him. He asked me, "Young man, what is it that you do for a living?"
How old were you at this point?
At this point, so you got to figure. I'm 41 years old now, so we can.
The only thing is your hands there. You got the mic.
Very loud. Okay. I won't do that. So, at that point, he asked me if I wanted to come in and actually talk to him about what mortgage lending looked like at that time. Again, we were at the turn of the year 2000, right? Exactly, and there was a lot of pandemonium going on with
the end of the world, and
exactly what was going to happen with the financial markets. But it was the best decision that I'd ever made. Had an opportunity to really learn way more than I ever learned in school about the craft of finance, as well as mortgage lending through not only his company but his family personally.
So now, starting there, did you do mostly residential, or that's how you started originally?
At that time in life, I was a residential lender. Believe it or not, there was a dot matrix printer in the office. We would pull credit on the dot matrix printer if it was a passing grade on the credit score, we would
Right.
take it to our branch manager, Mr. Jerry Seelinger at that time. He would have us write up a handwritten debt analysis. No computers, right? There was one computer
Everything
in the
was
office.
Yeah, yeah.
Well, you only got to use that computer if you were actually calling a client back and selling them a product that they, were calling or inquiring about. So we had our old handwritten application pages, our handwritten debt ratio calculation sheets.
Let's just say it took longer, right?
It took a lot longer. There were some interesting programs at that time. So the lending space as a whole, in 2000 and pre 9/11 was a very interesting time. I'm very blessed to have actually learned mortgage banking from that standpoint, because you can always learn historically from some of the mistakes that were made from your predecessors, and understanding that progress is always going to move forward.
That's true.
It's changed a lot, absolutely. My family's originally from Pittsburgh, even though I grew up in Potomac, Maryland.
So now, right now, I think you're from Frederick. Is that where your main office?
My family lives in Frederick.
Okay, so are you still doing residential? What are you doing nowadays currently?
So currently, for the last 5 years, I've been with NFM Lending. We are a Maryland headquartered company.
Okay.
Our national headquarters is located in Ithaca, Maryland, just outside of BWI Airport. Late 2017, we actually celebrated the ribbon ceremony for opening up our new national headquarters. Beautiful building. I encourage both of you to come down. I've been encouraging you to come down. We have.
I'm going to come down.
We have a state-of-the-art facility that's there, not only with technology forward underwriting, today's mortgage lending space, as well as our own video production center that we offer as a value add to our referral partners and our realtors.
Yep.
Interesting. Okay.
Yeah, still learning my way around the video production arena.
I understand. So now you're doing mostly residential, right? That's what you do?
Correct.
Now, most of your clients, are they looking to live in the property, or some of house hacking? From the real estate investing point of view, what have you seen in your opinion?
So, very good question. So my day is spent pretty much working in the residential space. From time to time, we do come across individuals that are investing into certain property types that would be, considered a commercial property. We also have individuals that are using financial platforms to finance commercial-based properties, or identified as a commercial asset. So in that space, I really try to get those individuals paired with the right partner within our local community who specializes in that commercial world. Me specifically, I work directly in the residential space.
Okay.
Yep.
Okay. So you deal mostly with obviously owner occupants and some.
So basically, when somebody wants money
to
buy a house, they come to you.
Hopefully they do.
Yes.
Hopefully they come to me.
So,
That's the name of the game.
So basically, I know a lot of people are going to have questions. So if I wanted to buy a rental property, let's say take a duplex. What would you need from me?
So very simple. We start the process just as we would any other traditional application. In a sense, and just for the viewers that are out there, duplex is a 2-unit property, whether side by side, up and down. Really, it's just about being a double plex that you're financing. So the basics, right? Anytime you filled out a credit application, they're going to look for things like pay stubs, W-2s, last 2 years tax returns, driver's license to make sure.
Which it's always best, from my experience, it's always best that they have as much as that information as possible before they get it to you. But I'm pretty sure they could pick up the phone, call you, say, hey, Jeremy, what do I need? I'm pretty sure you're going to say, I need pay stubs past 30, 60 days, 2 years tax returns. You're basically be able to tell them
in
exactly
the perfect world, I would like it if those individuals that are coming in and looking to qualify had that information in hand. Fact of the matter is, a lot of folks just start and they don't know what the next step is going to be, and we're very sensitive to that fact. I have a great team that works underneath of me. A young lady by the name of Emily Taylor, amazing young lady. She makes it very simple. Walking through the process, almost like a concierge service, and trying to gather those items. Every case is pretty much different, right? You're an individual. Underwriting nowadays is probably 75-80% automated, if you will.
Oh wow!
So through the algorithms that these automated underwriting systems are using, it will spit out what you need to qualify for the loan. So we try to collect as much as we possibly can up front, do 95% of the heavy lifting, if you will, so we're not constantly going back to the consumer and asking them to provide paperwork. Because it starts to
But that usually happens anyway.
Yeah. Well,
I'm gonna beat you up.
I know you're gonna beat me up.
I'm gonna beat you up.
If you get it done right the first time, I've always believed this in anything in life. If you put effort into it up front, we're very successful in being able to make sure that the clients understand what we're asking for. We're not going to ask you for something that doesn't make any sense. And I get the jokes all the time. I'll get an email from a client. Do you want my 4th grade report card or my blood type next?
And you say, I will if the underwriter asks.
If they ask for it, absolutely.
And they should provide that if they want the money. Because in my business, I work with a lot of clients that are buying investment properties. So we work very
great
closely.
Opportunity that's out there right now.
We work very closely with the lenders also. So I'm usually stuck in the middle of hearing about all this paperwork that the bank or the lenders asking them for. Now, what I tell my clients is, hey, if they're asking you for that piece of paper, obviously they just need it to be able to get you the money. It could be frustrating. But you just need to provide the documents. Now, just to break it down basic, what they would need would be how many pay stubs?
Very general. 30 days worth of pay stubs. Okay. At least the last 2 years of W-2 forms.
Okay. So this is for let's say you're working from 9 to 5. This is the ideal, the regular,
correct.
Right? Now, for people, just a big picture. So all the bank wants to make sure, obviously, is want to make sure that you have the ability to pay the mortgage and more. Right. So I think one of the, correct me if I'm wrong, but the debt to income ratio, right? That's a big variable.
Huge variable.
Right, and one way to prove that debt to income ratio is by getting the proof in paper, which is the W-2s.
Correct. 2008 caused a lot of disruption to our country, and my hat goes off to your story, Cristhian. I know that you made the leap of faith and jumped into becoming an entrepreneur and had, I believe, 3 months worth of reserves, and you just kind of went full time. So my hat's off to you. I believe that takes a very special individual and determined person to make that leap successful. Dodd-Frank, 1,700 pages of regulation law that was written specifically to regulate our financial markets.
After what year was that? What year?
So 2008 meltdown happens, right? By the end of 2010, Dodd-Frank was in full swing at this point. Very heavy regulation. The biggest thing, to answer your question, was the crazy programs that were out there previously where we didn't have to verify income, employment.
So you're telling me, because see, this is for me, I wasn't investing. I was out of the picture from the real estate investing realm. But you're saying that back in the day, 2006, 7, 8, you could say I made X, and you have to show minimal amount of documents.
You literally at this place
show up and sign the paper.
And at that point in mortgage lending, yes.
Oh my God!
To finish my point, the one big thing that Dodd-Frank does ensure now that two things. Number one, the loan officer has done his or her due diligence, and the ability to repay has been reviewed, right? So whenever we're looking through pay stubs, we're looking through W-2s, and we're looking through tax returns, does this family have the ability to repay this loan, or are we putting them into a situation that we know 6 months, 12 months, 18 months, whatever the case may be down the road, are we setting them up for failure, right? So there's a lot of predatory lending fail-sops that are out there that allow for these companies now to basically halt the brakes to make sure that these families are able to repay the loan.
Which is a good thing because
100%.
Hopefully that turns into less foreclosures than what we just seen. I know I'm still buying foreclosures because of the mess that it was the lending practices that brought us to where we are at today.
And in a way, I mean, I kind of associate another word in real estate investing, infusion show, in regards to buying and holding and kind of, as a landlord, just to kind of align these things, you want to make sure that your tenant has the ability to pay the rent. So it's same thing, same due diligence you're doing as a landlord. The bank is doing the same thing. Wants to make sure that obviously the debt to income is fine. That the credit, is another big one. That credit does like the track record.
Amen. Because we're partners. We're partners in that mortgage for 15, 30 years, right? We're going to lend against an asset or item of collateral, which is mainly residential property, but we're going to really be that individual or that family's business partner, if you will, for the next 15, 30 years. So we want to make sure,
hopefully multiple times,
absolutely show them.
It's very important and this is why I think you may even be downplaying how important it is to be the lender or have a good relationship with a lender. I think it's always very important to have a lender in your corner that you know that's going to be able to perform, show up to the table with the money, get the deal closed, and then when you're ready for the next deal, having somebody to pick up the phone, call them, set up the deal, get the money to the table, and close on the deal.
That's right.
So far what we've covered is
the variables, right?
The variables that you need. The pay stubs, credit score. What is the usual? What's
Good
your
question.
range for
Very
credit
good question.
score?
I think that was going back to
Yeah.
your original question. So residential mortgage loans nowadays, there are programs that are out there that start as low as 500.
500. Wow.
Yeah. There are a couple of platforms that are out there. The big three out there: FHA, conventional, and Freddie Mac.
Okay.
Will allow you the ability to utilize a manual underwrite. Remember, we talked a little bit about the automated process earlier.
Right.
Yep.
There's still a very large percentage of these loans that are being manually underwritten by an actual human set of eyes from the beginning.
Making
Not
sure
just
everything is
not
fine.
just running the algorithm to find out what's needed to make that decision, but basically going from point A to Z and going through that. So, right now we find that our starting point on FHA for primary residence is around 580 if it passes the total FHA scorecard.
Let me have one other thing. So I think why having another good lender in your corner too is for all the investors out there that are also flipping properties. Because I know he's talking about some of these products are for people that are living inside their properties. It's always good to know what loan products are out there for if you're fixing up a property, then you're staging it, and then you're flipping it.
Amen.
Because you know who to call.
Right.
Which hopefully you know that good person, and I will be calling. Hey, Jeremy, this is what I have. Actually, I think one of my clients are working with you right now.
Yes.
And I had a couple questions about a waiting period and just some of the little detailed things that go into it.
It's great to be able to pick up the phone and do that.
So you need to know what kind of products that are available to also those buyers that may be buying a flip property from you, because you don't want to get in a situation where you think you're closing at this date, but then something in underwriting goes wrong because they didn't have a good lender in their corner that didn't know what they were doing.
Well, it goes back to the 95% of the heavy lifting up front. A lot of those areas of concern or a lot of the hurdles that cause delays in settlement normally can be identified very early in the process if you're doing your due diligence. You brought up a really good point. So you have programs that are out there specifically for families that want to buy their own homes and move their families into it. You also have the ability to purchase properties that are duplex properties.
Yeah, and that very quickly for people that are just from scratch, you don't know, this is how to get the money, right? So we have FHA, which is, correct me if I'm wrong, but it's owner-occupant.
Owner-occupied,
so you have to live in the property. Is it 1 year minimum? Is that
so? At closing, there is a deed of trust, right, that you'll sign, which is your security note in which you're taking out against the property.
Right.
Normally, those security notes will state that within the next 60 days, you will take ownership or possession of this home and move in, owner-occupied into this property.
Occupied.
Owner,
So
right?
then
Right,
Exactly.
you have to live, but
stipulation.
There are other
How
stipulations.
long do they have to stay
in the property
So,
before moving out?
Let's just say that in that situation, we've seen folks that move into an FHA loan, and they've been out of that home and upgraded into a newer property within 12 months. There are certain guidelines about opening up two FHA mortgages at one time, right? If you have a growing family, right? If you are expecting, children and you're just running out of space.
That's good to know.
Very good to know.
So
I need you to email me that.
You can have two FHA loans
So
out
you
as
can.
long as you fit in whatever those categories.
Correct. If you are moving for employment, which is normally within 100 miles from the previous home, so you have the ability to do that. So very good question. Yes, FHA traditionally is going to cover owner occupied, but there are ways that you can have two FHA mortgages if you meet certain guidelines.
So Jeremy is gonna send me, if you could, send me some more information about that. I'm gonna share
Of
it
course
on the show and the comments and everything. Now, so FHA is owner occupant, right?
Yes, sir.
Now, the other side would be conventional. Now, the difference between those two is mainly, correct me if I'm wrong, is the FHA, you have to live in the property. And then conventional, you don't have to live in the property. It could be an investment property strictly,
Correct.
right?
So conventional, you have other entities that are out there.
Okay.
Some of the buzzwords that are out there: Fannie Mae, Freddie Mac. Right? You've heard of these entities. We have some amazing programs right now that are happening in 2018. Not just for families that are purchasing owner-occupied properties, but amazing programs to help investors to really start to stack the deck in their favor for their real estate portfolio. Right? I will tell you, regardless of what we're discussing here today, for the individuals that operate, and you brought up, a question earlier about getting in, renovating a property, flipping the property. Our traditional lending probably isn't going to be the best, option for that. There are private money warehouses that are out there, and that might be an episode for another show. But we really want to work with the families that are looking to build their wealth by real estate. Right. We want to get you into a home, make sure that you're not throwing money away anymore on rent. Right. Make sure that you have your house in order. But also, take a look at some passive income needs, right? You have the ability now with some of these conventional programs, as you stated, you don't need to live in the home.
Right.
Yeah.
You can actually purchase homes, renovate them, rent them out, and hold them under
So
Fannie and Freddie.
we also so we have a comment here, question. So everybody out there, this is a live show. If you have any questions, be sure.
Yes, please bring the questions.
Put them in the comment area there, and you can also call the phone number that's up there on the line. You have an expert here that could tell you how to get a mortgage, what you need.
Use that term loosely, right?
No, I only bring you here because you are an expert.
So Jeremy
I'm
is
not
the
going to refer.
I just want to stop by and see the studio. You told me we're going live in 3 minutes.
Hey,
so Jeremy is the key to getting the money traditionally through the bank, and that's what we brought him. So you can ask questions about, okay, what do I need? I work from 9 to 5. This is what I make. Give me an idea where I should, get started on if I want to go traditional route. Okay, this is the perfect time for you guys to ask. And really quick to recap. We talked a little bit about FHA financing and conventional financing. Now let's talk about a little bit the difference. What are the main difference between those two?
Very good
question. Though. There's a question.
Okay, go ahead.
So if I already have one FHA loan, can I co-sign on another FHA loan?
So very good question.
That's a hard question.
It's a very good question. We see it a lot. I'm assuming this is a question regarding a sibling, a parent, or a child,
or a girlfriend.
there are certain rules that won't allow you to co-sign just to co-sign for someone. However, if you have a current FHA mortgage open and you are approached by a family member or other interested party, you can actually co-sign on to that other FHA mortgage and give them an ownership interest in that property as a non-occupant owner.
Now,
we see a lot of that to help younger families without established credit, without established income backgrounds. Correct. Exactly.
Okay, so you're saying if, let's say my parents, let's say I didn't have credit or anything like that, my parents can co-sign and I can have my own FHA. So I would be basically ownership, it would be my ownership and their ownership.
Correct.
Of my father or mother.
That is correct, because they would actually be considered an owner of that property because they are a non-occupant co-borrower.
Which is another question that I have. So if you have two people and obviously one, their credit, let's say, is horrible, and the other person's credit is great, but the one that their credit is messed up has the money for the down payment, could that work out?
So really in that situation, that's case by case, right? We're going to get in, we're going to dissect it, we're going to figure out, is this something that we can fix simply by looking at the utilization ratios of what credit has been borrowed? Can we help to maybe get that individual or that family with the lower credit score back on track? Can we help them within the next 30, 60 days and get them to the point where they qualify on their own? And is this something that we can do ethically to help to get them into a position to buy?
So which one is more important? I mean, I'm assuming all of them are important, but if there was like the income, debt to income ratio, is that, would you say, consider the number one key?
So you have moving targets here, right? First and foremost, the ability to repay, that's very important right now.
Correct.
Because Dodd-Frank, they have some pretty significant, regulation against making loans to families that
Now,
justify.
do you see any of that loosening up at all right now with new products and things like that?
I don't.
So I know it got really
believe
tight.
I don't believe that the ability to repay rule will fully go away.
Yeah.
We have some great programs for self-employed borrowers that allow you to actually calculate the gross deposits over a 12 to 24 month period. You average that number and you take a certain percentage of those deposits, and you can actually use that as a qualifying income.
Now, what's
So-
the credit score for that program?
That program with us at NFM, we use it's a non-QM product. It has a 650 credit score to start.
Okay, 650 credit scores.
650, self-employed
And-
at least 2 years.
Then you go, okay, so 2 years tax returns? And
So we
then-
don't look at the tax returns in that situation.
Oh, okay, so you just go off of bank statements for 12 to 24 months.
Correct.
And then
We go through the verification process to make sure that they are an owner or partial owner of an entity
Okay.
to provide that. So there's a lot that's out there. I mean, you have a lot of families, and again, I'm going to circle back to your situation. The leap of faith that you took whenever you jumped out of your 9 to 5. A lot of folks don't necessarily have the resources to do
Right,
that. Have a
that's true.
3-month buffer.
That's true.
Most folks are literally working their 9 to 5. They come home, they get their kids fed, they get their kids put to bed, and then they start grinding on their dreams, right?
That's
and
true.
whatever they do between 9 and 2 a.m. is what they're building their legacy on. So those are the folks that we really want to reach out to, because, I hate to monetize any type of conversation.
right.
But truly, if you have passive income coming in from real estate investment, and you have the ability to utilize those resources, it makes things in life a lot easier.
Yeah, it does. That's how I basically got started. Just looked at every single property as being an extra paycheck. There's definitely opportunities out there. We had spoke a little earlier about teachers,
Yep.
teachers, firefighters,
First responders,
first
law enforcement,
responders,
yep.
law
Veterans.
enforcement.
Yep.
Definitely that segment, which
Yep.
I would say, and correct me if I'm wrong, that segment, I think their jobs are pretty stable.
Very stable.
I
Yep,
think
absolutely.
it's a pretty stable job, which is good.
Firefighters are dedicated. Law enforcement's
yes.
dedicated.
Correct.
Our teachers, our educators,
Correct.
in the United States, they're very
Correct.
dedicated.
Correct.
The
Correct.
big lobby that I feel we should all do a little bit better at is helping the men and women that are law enforcement, first responders, the folks that are responsible for educating the children of our future. In those career fields, sometimes it's very expensive to become certified or educated to do that job. There's also a ceiling that you hit eventually in the amount of income that you can make.
So where I was getting at with that, everything, especially in the real estate arena, or I think anything that you do in business, you have to leverage whatever opportunities that
Right.
you have. So in that case, what I would call that is basically leveraging your stable job. So you have the stable job because of what you are dedicated and
Right.
what you're doing on a daily basis. So then you leverage that job to then be able to buy another property to have passive income, and that may add up to half a check or a whole check, and then you just keep adding on property after property.
Yeah.
And then before you know it, it happened to me.
Right.
Before you know it, you're making more off of your rental properties than what you are at your job. Now you could
You have to grind to get there, though. Right?
yeah, you
have
can grind to
yeah,
get
yeah.
there. It's not easy, but
You have
my
to-
clients don't even have to grind.
Right.
They don't have to
You're
grind.
going out and you're doing it.
They
for
don't
them.
have to grind at all. They just need to have whatever their down payment money is.
Right.
They have to have their credit score where it needs to be.
Correct.
Then I call you.
Right.
You get them the money.
Right.
Yeah.
We manage the property for them. They're left with that,
And they're on to the next
expense-
project.
Yeah, after
Right.
the expenses are taken out, they're left with a profit. They didn't have to do any of the heavy lifting, so they don't have to grind like I had to grind though.
Right.
I had to buy properties, fix them up at the beginning of my day. Then I'd go in, I'd work a second shift.
When you
job.
started, were you doing all the work yourself? That was probably way before you had the crews
I
that you have
was,
here.
yeah. So what I would do is,
what was that hour? What would that look like? 'Cause if you were at a day job, I'm sorry to get us off task
that's
here,
fine.
but I'm assuming you had a 9 to 5. Right?
No, it wasn't a 9 to 5. So I would work. I'd go in I started Toys R Us first of all.
Gotcha. I knew that about
And
your story.
that was night shift.
Right.
So I'd work night shift and then not sleep, do what I had to do during the day, get a couple hours of sleep, then go work on third shift at Toys R Us stocking the shelves.
Do you miss Toys R Us now?
No, but I did learn some
They
things.
taught you a lesson.
I learned some things while I was at Toys R Us.
So another question, really quick. So we have some audience here that
Yes.
want to get in through.
How's everybody doing tonight?
Right.
Right.
And everybody's saying, okay, well, I'm a beginner.
Yes.
I'm working 9 to 5. I have the paycheck. I think I can buy, or I got pre-approved. Now I want to go and get a 4-unit building because Cristhian has told me all the time I can live in one side, let 2 units pay the mortgage, and the other unit is going to pay the maintenance costs, taxes,
Correct.
insurance,
Yes.
and I can possibly live for free. So that's a big advantage. So how?
Very popular right now amongst
Yeah.
our demographic of anywhere between 21 and 32.
Right. Now, how important it is. So if I'm getting FHA, my understanding is that the other 3 units, the income generated, it will benefit, and I could potentially buy a bigger home or a home with a higher price point if there's a higher rental income coming in. Could you talk a little bit about that?
You bring up a very good point.
Yeah.
So there's a big difference in FHA financing and conventional financing when it comes to existing rent rolls or
Okay.
non-existing
Okay.
rent rolls, rather. So in the illustration that you're using, it sounds like that 4-unit may have
3 tenants, right?
It has 3 tenants that are in there. You have the ability to go in with a non-occupancy unit that is lived in by the buyer themselves. We would entertain the last 2 years of verifiable rent rolls
Okay.
coming in from the seller's tax returns on that property
Okay, that's good.
to verify, to
Okay.
verify exactly what that property is bringing in. Conventional is a little bit looser, right? You're going to have a little bit higher down payment, but they will allow you the ability to use current signed lease agreements
Okay.
and evidence of executed lease agreements on that property as long as there's
Okay.
12 months left.
So
remaining.
in FHA, you're saying that it would be like an averaged out. It would be averaged, but when conventional it's the actual current leases.
That's the actual current lease.
Oh,
that is
okay, that's
correct.
good to know. That's
Yes.
very good to know.
We run into that a lot. Where we run into it a lot, a little bit different than your situation. A family, they've just outgrown their home. They want to buy this nice, beautiful home.
Right.
Now, they're getting into the new property, but they definitely don't want to leave this baby that was their first home.
Right.
They have so much connection to, because let's face it, in today's world, the rental markets are, right?
Yeah.
They're up there. So they know that they can generate some good income. As long as they're using a conventional product to purchase their new home, we have the ability to use the executed lease agreement,
Okay.
proof of first and last month's rent, and security deposit to offset the new or to offset the previous mortgage payment.
Any idea how? Let's say 2 examples. One, the 3 units are completely vacant, and in the other one there's income. How? What would be the main difference? Obviously, they could potentially buy at a higher sales price, right? If there's rental income, because their ability to pay is increased.
They could. I will tell you, in that situation, if you are looking at FHA, we're going to take a very conservative approach, and most companies will do the same.
Right.
They would love to see that individual that's purchasing that home be able to qualify for that collateral without any of that income on their own, right? Because then that goes back into one of the compensating factors to the FHA scorecard that I had mentioned earlier.
Okay.
Yeah,
But it is out there.
Yeah, that's been my experience on. So I've helped some people move into
Very
3-unit
different on the
building.
very different on the conventional program.
Yeah, that's use FHA, and that's what they basically had to.
Because
their income had to cover the loan before.
Right.
The rental.
100%.
So.
Conventional is very different.
Yeah, a lot of people like house hacking because obviously not a lot of people have 20% of 150,000. Nobody has 50K laying around, but people have 5, 3K, 7K. They saved up for a year or so. And so doing an FHA, buying a 4-unit or even a duplex, because some duplexes are 1,200, 1,500 square feet.
Yes.
I mean, you can find them. If you're talking Hagerstown, you go to the northern end, Potomac Avenue, Irvin Drive. You have big duplexes, big duplexes, 1,500, 1,600 square feet. You can rent one side for probably $1,100, $1,200 because they're huge. We're talking about a 3-bedroom and a two bathroom in some cases.
I got a very good question for you that people's been
And
asking.
we're going to come back to that because I want to follow up on that because there is border income as well that we'll talk a little bit about as well.
Yeah, let's
Do
come
you
back.
guys write these kind of loans?
Anytime that somebody asks me that question, I get a little scared. When
I love
when they
it.
preempt the question
that
ask you do you write this type of business?
I'm going to ask you these kind of
Of course
questions
you
all the
are.
time.
I dig it.
So I had a lot of people ask me questions. They see a property, let's say it's $100,000, okay? They want 80% financing or 70%, right?
Okay.
And then they ask the seller to hold a second. Is that something that can happen?
So there are. Obviously, we try to use conventional means for combined loan to value calculations. There are going to be certain thresholds, right, that you just can't borrow above and beyond.
Okay.
First and second lien mortgages put together.
Okay.
There are, these wonderful programs that are out there. Hagerstown specifically here, you're very lucky. You have a lot of money that's out there for the local block grants that are 0% deferred second mortgages that the city and county will actually allow you the ability to use that silent second mortgage to offset some of that bigger down payment.
Yeah.
We also use local credit unions and local banks allowing individuals to put second mortgages behind the first mortgage. Normally it's a fixed installment somewhere between 1 and 20 years, or a home equity line of credit, which basically revolves like a credit card and can be used over and over as the balance is paid down. You can use that. But to answer your question, yes, there are private second.
I'm trying to nail you down here.
There are programs on the conventional side that will allow for certain combined loan to
For
values.
owners to hold a second.
For-
So then
for
when
the-
you say the loan to values, then is there like a standard of even if there's a second, it can't be more than, what, 90%?
Yeah, I
of the
believe that
value?
it's the total loan to value. I believe on that is 90 or 95%.
Okay.
If it is being held by a private entity or interested party. which
So
will
it
be the
is
seller.
possible to do that type of loan. You just may run into some problems with the loan to value.
You run into. I mean, there may be easier ways to do it. Is what I'm
Okay.
saying, right?
Okay.
And I'm not saying it's right, wrong, or
Yeah.
indifferent, but there may be some old school ways of thinking that that's probably the easier way to have that done.
Yeah.
But in today's lending space, there are some great programs that are out
Some
there.
other creative options.
It'll tie into it. We have a conventional 97% program that we use now for as little as 3% down.
Okay, that's a great question because we have Christian says, do you have any non-owner occupied loans that are less than 20%? So like conventional loans that are less than 20%. You were talking about
Very,
that.
very good question. Actually, I had some notes here I wrote down.
We'd love
So-
to hear that because
Yeah.
these people are going
That
to
you
eat this
do
thing
not
up.
live in, though, correct?
You
Yeah,
do not. These are
okay.
true investment properties,
Okay,
right?
yeah, you guys better be taking notes about
Yeah,
this. Okay?
right. So traditionally, you're looking at somewhere between 10 to 20% down. Sometimes, depending upon the credit score, you may even need 25% down.
Okay.
I will tell you right now, one of the hot programs that's out there for investors building their portfolio of properties that are in their rental portfolio. We have a Fannie Mae home style that works just like the FHA 203K loan. For those of you that are tuning in that don't know what that is, it's an acquisition loan plus renovation money to bring the property up to code or to get that property renovated. Believe it or not, with the FHA 203K, it's for owner-occupied only. Fannie Mae now has a home style product out there that allows you to use this product on a non-owner occupied,
Really?
allowing you to actually acquire and renovate the property together with an estimated down payment of right around 20% on that program. So it's cheaper.
But they provide the rehab funds.
No, rehab funds are already built in. Way cheaper than private money, way cheaper than hard money.
Yeah.
It is a conventional loan, so it goes against their personal credit report and against their total loan count with Fannie Mae, which I believe right now You're allowed to have 10 open and active finance properties
So it
through
is
the
10.
through the Fannie Mae guidelines. Yeah, we work with a lot of those investors.
Cool. What is this called? Like conventional rehab, something like that? Or?
It's a Fannie Mae home style. Correct.
Home style. Okay.
Correct. And on that program,
I told you I had a ton of information.
yeah, there's acquisition.
Yeah.
But then you can also borrow for renovation up to, I believe, 50%
Okay.
of the subject to completed value back in the renovation escrow.
Okay. So that's now. Tell us a little bit about that. You said 3%. I think you said.
So kind of rewinding a little
Yeah,
bit about, because it sounded like the question was out there before.
Yeah.
What am I looking at getting into, right? Well, first and foremost, there are programs out there to help families get into their own homes that they
Right.
want to live in
Right.
for as little as no money out of pocket.
Correct.
Very popular right now is a 97% conventional platform, which is very attractive, right? Two reasons. FHA is 3.5% down,
Yeah.
so your down payment is less. FHA right now, the mortgage insurance, it's part of the DNA of the loan. So it's on there for the life of the loan.
Okay.
Whereas the conventional side, you have options to have that removed
Okay.
at a
Which
later
would lower
date.
your
So your
payment.
payment can eventually.
Well, so you're saying that I can buy a property that I don't have to live in there, but I can come in with 3%. Now, how?
What do you do? It is owner occupied. You do.
Oh,
live
you
in-
do
yeah,
have.
yeah,
Okay,
yeah.
you're talking. So it's a conventional owner occupied.
It's a conventional owner occupied.
Wow.
Where we were going with that, you
Uh-huh.
talked a little bit about some of these platforms that are out there. Believe it or not, when we're seeing in the demographic now, 21 to 32 years of age, what would be considered as a millennial, but I hate to brand anyone.
Yeah.
But what we have found is this specific demographic, they love the opportunity to get in with very little money out of pocket. They're very comfortable and conservative with the monthly payments that they have, and they have friends or family that they then can bring in for border income under these types of
Okay,
loans to help
okay.
offset their payments.
So what's the lowest amount of down payment that I need for a conventional? Meaning I don't have to live in there. It's strictly an investment property. In my experience, I've seen it's been 20, 25, right? 21%.
Correct. So we have programs that are going to be anywhere from 15 to 20% down. There are some 10%.
Okay, that's what I
platforms
want to know.
that allow for a 15% first mortgage, right, and then a 5% second mortgage behind that. So your combined loan to value would then total 90%, allowing for 10% down.
Okay.
But again, some of those, and there are lenders out there that are doing non-QM, non-qualified mortgages at this point that have some really exotic stuff. It's not really our, it's not really our
Yeah.
forte at NFM. We don't really go that deep into the risk grid.
Now, what about the investor that may be using private money?
Okay.
What does that deal look like? Say I buy a property, it's worth $100,000. The ARV would be worth $100,000. I'm all in at $70,000. Then I bring it to you and I say, hey, Jeremy, I want to refinance this. Do you do refinances also?
So we do. There are going to be some time constraints that are on there.
Yeah.
Obviously, we want to make sure that there aren't, inflated appraised values, things of that nature. A lot of that, again, change with the...
You guys do
Cha-
your own appraisals through a third party.
Correct.
anyways,
So it's
correct?
all third party, right?
So
exactly.
it shouldn't be inflated because that would be a third party.
Agreed, right?
Right.
So, again, Dodd-Frank, 2010, a lot of things happened. HVCC, the Home Valuation Code of Conduct, is one of the regulations that's written in that 1,700-page law. It really spelled out specifically the process and how I am able to communicate as a mortgage lender with the appraiser.
Right.
Nowadays, I mean, that's a huge no-no. You don't ever want to be, found communicating with any type of an appraiser, trying to, manipulate values or things like that. So yeah, all of that goes through a third-party appraisal management company.
Yeah.
What's nice though in today's space, the regulation was a bit much when it first rolled out, but now that we're operating with so much regulation and the fail-safes that are out there, we're making so many better loans, right? And when you make better loans for your investors,
People are in better position.
There's true equity that's in the market.
Right.
It's not an inflated equity
I understand.
as we once had. I'm sure you looked at some properties before. You're just like, I just don't see that.
I just
Yeah.
bought one that sold for $203,000. I think it was 2006, 2007. I just bought it for $68,000.
Right.
Yeah, I bought
Over
a
200.
little single family home for $32,000 last year,
Yeah.
and I think it sold in 2008 or 7, I believe, for like $90K, and I mean, you know,
200,000 to 60.
Yeah, I mean, so that's the one thing, and I welcome that all day long because
Yeah.
again, we have true equity that's in the market.
Yeah.
And we know that the folks that are out there qualifying today
Yeah.
actually have gone through the ability
Right.
to repay threshold.
which is great. I think
Yeah.
that's a great thing. It's
Yeah.
a beautiful thing that it's been organized that way. I just cannot believe that in 2007 it was like so easy. The pizza guy was having 3 homes.
Oh yeah, you had a pizza guy that
Yeah.
would report, $300,000 of gross income buying, $400,000 homes,
Yeah.
right? So,
Yeah.
hindsight's always 20/20.
Yeah.
In that situation, I think that we could have done a little bit better when the floodgates were open,
Right.
at regulating that. But in today's lending space, we have some great programs. I mean, folks that are going out to supplement their income, they find that it's a much more enjoyable experience.
Okay.
Not just, hey, sit down, sign your name, here's
Yeah.
here's your funding.
Yeah.
They truly understand that the asset that they're acquiring is profitable, right? It's going to help with, building the cornerstones to their wealth, but also for generations to come, if this is in their retirement portfolio,
Right.
you're not going to have those.
Yeah.
Hopefully, you're not going to have those big ebbs and flows as we once
Yeah.
saw in our markets.
Now, one question that I had, and I'm sure a lot of people out there have it. What about interest rates? Okay, what's going on? What do you foresee? This is a big topic.
It's a big one right now.
Yeah.
The last 3 weeks, we've gone through some pretty volatile pricing swings, right? So
Okay.
anytime you're looking at interest rates, there's a margin that's tied to them that's backed by mortgage-backed securities that are eventually sold to Wall Street. So in the secondary markets, it's been a pretty volatile ride for the bond markets that are securing these mortgages. I will tell you, I mean, if you're following any of the verbiage that's coming out of the FOMC meetings at this point, you have a new Fed chair that just took the baton. Powell just took it
Okay.
from Janet Yellen. They had their first meeting, I believe it was January 28th, 29th, something like that. I forget when the date was, but
Yeah.
they did specifically say that inflation right now is being tamed, and that they anticipate their first adjustment of 2018 coming in March. So
March? Now, would they?
it's already built in, right? So I mean,
Yeah.
that verbiage, markets react. There's a knee jerk
Yeah, that's
reaction
true.
when depressed minutes are released.
Which I think if you're buying correct anyways, I personally, on the investment side, don't think that it affects much. You just have to take that into consideration with what you're buying, what you can pay for it, and just do your numbers and make sure you profit.
If $40 or $60 a month breaks your deal,
Price
that
should be
deal
doing it.
that deal was too tight anyway. Number one. Number two, keep in mind, we talked about this earlier. I hate to actually share my age, but 41 years old. I started doing this in 1999. Interest rates were staggering. Right now, you have rates that are
Yeah.
well below 5%.
I've heard it was like 12, 13%. Is that
Yeah,
right?
I mean,
Was that in the 80s?
historically, I mean,
Yeah.
you have some interest rates that were pressing on the door of
That's what
of
I've heard.
20%.
15%, 18%.
So right now the money is still very cheap, right? You have money
I think
that's
it's
out
cheap.
there
I think it's cheap.
less than 5%.
Right.
So if your return on investment, if you're not going out and you're grinding and you're building your rental portfolio, if you're not at least at a 10% margin, right? I mean, you're probably not going to
Yeah.
really be into it anyway, right?
Yeah.
So
Yeah,
is
that's
it?
how
I mean, I
feel.
know it's a speculation, but is it bound to go up? The interest rates? Is that
I
what it is?
truly believe that 2018 is the year that we will see some significant increases. It's a good thing.
Yeah.
Number one, it brings back equity into our markets.
Uh-huh.
For a very long time, a lot of people will argue this point, but the Fed actually held up a lot of our markets, specifically our housing market, which was a very strong, secure leg under the table. But again, there's no money or equity in the markets at a
Right.
2.5% bond call, right? I mean, you actually have to have some meat on the bone. As interest rates come up, and you guys will love this, your private investors that are on the sidelines, you're going to see more and more money start
Coming
to
in.
pour in because there's more opportunity that's there.
Okay.
Price of living obviously is going up, right? Inflation is tame, but with cost of living going up, you also have higher market rents. Right. You also have more people back to work.
Got to make a return on your money.
I like that
Regardless
idea,
of
man.
what
I
the
like the
markets
idea.
do, there's so many options in real estate that you're going to be able to find a way to make money. If it's flipping properties, you can do that. You can buy and hold properties.
Right.
You can make a profit there. If you want to get into lending out your money, you can make anywhere from 10 to 15% and not do one thing, but hold the paper. So there's so many different options out there.
There's a lot that are out there.
And I think too, Jeremy, like you mentioned before, there is a lot of every individual is different.
Very different.
So there is no way for we can give you the variables, right? That the formula, or at least the variables that you need to be aware of. But everybody's different. Everybody has a different credit score, debt to income ratio, down payment,
and that's ever changing as well. Right. So I work with a lot of people. This is just a magical time of the year, right? We just had the holidays, right? The holidays just passed. Family spending was up.
Yep.
Tax return money's coming back in, right? The refunds are coming back.
Yeah.
They literally plan every year to have a higher utilization of their credit cards during the holidays, but rely on that federal tax return money to pay that down.
That's true.
So what you qualify for today with those higher debts until they're paid down, literally tomorrow once they're paid down, you could flip that credit score, 10, 20,
That's
30
true.
points.
So to answer, like everybody's probably saying, like, but my status is different, So how can you find out? I think the best thing to do, whether you want to get an FHA loan or a conventional loan, and I tell all my clients, investors, I tell them the best thing to do is talk to a lender. He's either going to tell you, okay, well, you have everything, you can buy up to X, or he's going to tell you, you can't right now, but you need to do X, Y, Z.
Correct.
And then you're ready in the next 6 months, year, or year and a half, whichever it takes. But at least you're on a path to get where you need to be.
And that's really what we strive to educate our consumers on. Right now may not be the time. Right. We hope that it is, and trust me, I'm in business to help families and go to closing, and I just so happen to be able to make a living at doing it. Nothing more rewarding for me than sitting down at the closing table with a family that never thought they were going to be able to buy or invest in a home.
Giving them a road path to get there.
But giving them the recipe for success. I will tell you, and I'm sure you probably talk with potential investors that want to sit and talk with you about how they can grow their income. You can give them that path to success. Truly the ones that want to strive and make that goal a reality are the folks that come back and work very hard time and time again and see it done. So I would suggest, to answer your question, sit with a professional, figure out where you are now, set a baseline, right? If now is the time and you qualify, take a look at all of the options that are out there. Number one, make sure that you're not just pigeonholing yourself to one program, because there's, multiple programs that are out there. That's number one. Number two, listen, right? Take notes, listen to what that individual is saying, because they're more than likely the professional having that conversation at the table. And then timeline really with your family, with your investment partners, timeline with your significant other. How soon do you want to be in the home? What does our monthly budget look like, right? I mean, that is
how
literally
are we going to get there?
How are we going to get there?
Exactly.
That is a conversation that can be had in as little as an hour to 2 hours, but you then can walk away with the knowledge and the blueprint of how that's going to get done. Right.
And I think that's great, and that's what we brought you here, so you can answer some questions. And we answered a couple here. Now, I know...
Don't be afraid, right?
Yeah, I'm sure a couple people are there wondering, okay, you know what? The first step is talk to a professional. How do they reach out to you? Because I know you're an expert in your field, so how can they reach out to you?
I'll get some information put up on the feed below. I believe we'll share some of my contact information. I do answer my personal cell phone up until about 9 o'clock at night, 9:30. Getting a lot of trouble for that. You can reach me directly at 301-676-5506. I also will share an electronic business card below. Shoot me an email if it's something that you feel as if it's just a quick question and you may need some direction on. If I can't get the answer to you immediately, I do have access directly to my underwriting manager and my underwriting support desk. We'll get you that answer right away. and
Okay.
we'll put it in writing. So that's a big thing, right?
Yeah. I've seen you do that.
If you're being promised something and it sounds too good, get it in writing.
Yeah.
Yeah. So, well, we certainly appreciate you coming in here. You answer a couple questions here. Anybody interested? Go.
I'm having fun. Like I literally
me
stopped
too.
by. I love this
I know.
studio.
It's nice.
think,
And the videos are good. Once you see it, it's like, whoa, where were we, right? Because you just saw the light.
So congratulations on the big turnouts. I see that your first Saturday event is really growing.
Yeah.
Do you mind if I ask, like, where did that brainchild come from?
So I'll add where it came from for me. Christian can add where it came from for him.
Yeah.
So basically, how it came up was I do a lot of networking. You see me out there doing networking. Some things I seen I liked while I was networking. Some things I didn't see while I was networking. So I just wanted to open up a format that local investors or investors from outside the area could come and network and be able to share knowledge freely without really being charged to do so. Also trying to make sure that everybody knew a fundamental place to come from to find a good deal that made sense and I've tried to do as much as I possibly can to keep them out of
That's
a
where
bad
Coffee
deal.
Connection started, just from the same place.
I just was trying to make a safe place to where I could get people with like-minded individuals in the same room to share ideas.
That's where the best ideas happen.
And deals.
It's all about who you surround yourself with.
Network has just been huge for me.
Yeah,
so that's
one of the reasons why we first we started, because I went to different meetings in the beginning, and I didn't get what I wanted. I just wanted education, guidance. I didn't want it to get the pitch or anything like that. I wanted to get the education, the networking, kind of get a small. It started with a mastermind, because we talked about in the beginning. Me and Charles,
mastermind groups are big right now. They're huge.
Charles
right
has
now.
been thinking about it, and it was on my head, and then he shared we should sit down and talk about it. So one night we just sat together and we were like, fusion, real estate, fusion. Because I do the buy and hold, he does the flipping. So we figure, okay, we can put our heads together and get people, and it's great that it's growing. I think we had 18, 20 people, right, last time. And
it looked like it was packed.
No,
it was packed.
Actually, it might have been more than
a little
that.
more than
we
that,
ran out chairs.
Yeah.
That's good.
So I think it's
if
great.
any more people would have
we got a
came,
lot
they
of
would have been
people,
standing.
especially in this stream. We're getting like 10, 15, 20 people at a time. And we're only getting started. We want to bring the experts here, local, and people from DC, and we're gonna bring a lot more people. Mark Owens, who is gonna come in, he's a big guy in Baltimore, has a lot of rentals. We're gonna set up something with him. He's gonna be talking about. So we want to bring a lot of value. On my end, the buy and hold. I want to bring the buy and hold investors that are big, small.
Those are the investors I want to talk to.
Yeah, well, they're gonna be here. So
I have some great contacts inside of DC if you guys, because I think this platform is amazing.
Absolutely. There's people here, a mix
between
between beginners, seasoned, people that want to get excited and motivated. And I mean, I'm all for it. I think it's growing, and we certainly appreciate you coming in here
well,
today.
congratulations on the success of not only
Yeah.
the show, but also your growing meetings every month. I look
Appreciate
forward
that.
to seeing exactly where this
Exactly.
goes in 2018.
Okay.
Once this ice stops outside and we get some sunshine outside,
I know.
probably get out there to look at more properties and get some more excitement going.
Yeah. Well, in closure, guys, we want to invite you again, Charles. I think it's March 3rd, correct? Our second meeting
First
is the Saturday
Saturday
of every month.
Yes, first Saturday of every month at Bulls and Bears restaurant. It's in downtown Hagerstown.
Yeah, it's at
Love it
noon.
there.
It starts at noon always.
What's that?
I love it there.
Yeah, the food's
Oh,
good.
the food's
Yep,
great.
food's good. Yep.
Food's great. So we want to invite you again. I mean, we're 3 weeks, from that date, but we want to invite you today and the next time we do our show. And bring all your questions. If you have deals, bring your deals. If you have any questions about wholesaling, buying, holding, flipping, I mean, we're gonna give you. And if we can't give you, we're gonna bring somebody to answer those questions. Other than that, again, Jeremy.
Hey, thank you, gentlemen,
very
so
much.
much.
Yeah,
Congratulations on the new studio. I love it in here.
Yeah,
appreciate it.
Very comfortable and clean feeling in your studio.
Absolutely.
I dig it.
Yeah.
All right.
All right.
I love it.
Thank you, guys.
Thank
Take
you,
care.
guys.
See you guys later.